right?
100%. Look, I think that there's three main things for investors to look at. One is that momentum and breadth have improved substantially in the last couple of months. The second is that we are in a very bullish period. The pre-election year seasonality for the first quarter is better than any other of the 16 quarters that make up the presidential cycle. The third is that we continue to see pretty excessively bearish sentiment across the board. Now, we have to differentiate that. You juxtapose that. The near-term sentiment has gotten a little more optimistic. However, if we saw anything from recent reports of investor risk, people are very much on the sidelines. We're seeing very high levels of investor cash. That makes me think that we are in very much a bull market that can continue.
A bull market. So starting from the lows in October, this is a new bull market?
I think the lows were put in October. I don't think it will go necessarily straight up all year, but I think that we do see signs of technology now coming back with a vengeance in the last couple of weeks. Tech is now the third best performing sector on the year. That's obviously quite important, it being 27% of the S&P.
Yeah, I know, but what leads you to believe that has any staying power? I mean, that's the biggest debate in the market right now.
Because almost everybody is saying the exact same thing. The market is not getting the Fed's message, and that's really interesting to me. They all say that the market should be lower. They're trying to figure out how this market can rally. If anything, it's gone from extreme pessimism to now skepticism. We haven't reached bullishness yet. We haven't reached giddy-type feelings about the market. So, look, it's a market where the market's respecting inflation selling off sharply, as well as a pivot potentially with the Fed, at least in the U.S., far more dramatically than what we'll see in Europe. The market certainly respects that, and cyclically, we're still doing quite well.
So you're telling me that the value over growth move is over? It's done? That was it?
Well, it's interesting because you see a lot of tech stocks are now been put into the value bucket, and a lot of energy stocks have been put into growth. So
yeah,
you have
I know,
to really understand.
But you know more broadly.
I think energy is going to come back. I think both healthcare and energy have a chance of snapping back. But I also see technology as being a phenomenally, a good sector to position in for 2023. So I think interest rates continue to come down over the course of the year. That should fuel growth. I think growth comes back, and tech outperforms.
You think the Fed cuts rates this year?
I'm not a.
I know you're not a fund. I know that, but you can't have a view. Your view doesn't work if rates continue to go up, or at minimum stay where they are.
Well, rates haven't continued to go up. We've gone from 420 down to 340 in a very short period of time. We have a 2-day bounce. We're seeing evidence of rates pull back, not move dramatically higher. If rates get back to 4%, then I agree. There's a very high correlation between treasuries and equities, and that likely could be problematic. But
that speaks to what we said before, though, about the market and the Fed being off sides with one another.
So let's take a look at the dollar and selling off substantially and say that Europe remains committed to hiking much more aggressively than the U.S., and that should be actually a bearish factor for why the dollar can sell off further, and that likely is going to be a tailwind for U.S. equities along with rates pulling back. So those two reasons, coupled with maybe the consumer is strong. The labor market obviously is in good shape, and maybe that's the last shoe to drop. But we haven't really seen any strong evidence of that. Technically, markets have been resilient, and it's only been technology that has lagged. We're seeing substantial rallies in Europe, EM, China, everywhere around the globe except for U.S. And now technology is coming back, and so investors are on the sidelines watching this happen, saying, "Well, how can this happen?" Well, bottom line is, we don't care about the economy. We care about the market, per se, right? They're both important in the long run. But we need to really recalibrate how we think about the market and using earnings as a way of forecasting the market, because rarely do they line up in the short term. Last year, we saw earnings higher, stocks went lower. Right. This year, earnings are down, stocks are up. So at what point do we say the model of seeing where earnings are is truly the right way to look at the market?
Just give me a number. I really got to go. We're at 4,100. Where are we going on the S&P then? What do the charts say?
Well, a lot of it. My target is 4,500 by the end of the year. Okay. I think even in the short run, by February expiration, we likely lift up above 4,200 in the near term.